Good afternoon, everyone. Welcome to our final webinar on the most recent series. For those that haven't met me before, I'm Mark McAllister, Senior Partner for Holborn Assets based here in sometimes sunny, sometimes wet and windy at the moment, Cape Town in South Africa. And I've been helping returning South Africans to get financially fit to return back to South Africa for about the last 5 years or so. If you haven't already done so, please feel free to connect with me on all of the social media channels that you see on screen now, and you can receive the latest updates on what you should know when getting financially fit to return. Okay, so here's what we're going to cover today. So we're going to go through a number of areas around financial planning, basics, things like foreign exchange, bank accounts, property, the dual tax agreement, pensions and a retirement budget, and also a new handy returning South Africa family budget tool, which we're very excited to be launching today on the call. There is a section at the end for answering questions, and I would request that you utilize the Q&A button at the bottom of your screen to type a question, and I'll do my best to answer it right at the end when we have the Q&A session. So thank you all again for attending and taking part out of your busy schedules. Okay, a little bit of introduction then. So let's get started. To give you a bit of background about our company, Holborn Assets is one of the largest independent financial advisory business globally. We're still family owned, and we've been around since 1998. We manage and administrate assets just under $2.5 billion US. We've got clients in over 30 countries, and we've got offices in 11 different countries as well. We specialize in helping globally minded expats with their finances, and in particular those who've worked in places like the UK resettle into their home countries like South Africa. And in South Africa, we've got offices in Johannesburg, Durban, and of course, Cape Town, where I'm the senior partner. Feel free to look us up on Trustpilot. Very proud of our 4.9 rating out of 5 stars from independent reviews from our clients across the globe. So over recent years, South Africans have dispersed far and wide around the globe. Here's just a small selection of countries some of our clients have returned to South Africa from, and we'd highly recommend that you work with an advisor who knows about the jurisdiction that you previously lived and worked in, and is up to speed on local tax rates, dual tax agreements if they're applicable, and what works best for you now that you're heading back to South Africa. So as both a qualified local representative and an international wealth manager with the Chartered Institute of Securities and Investments, I'm happy to assist with any inquiries you may have in this regard. And though I specialize in the UK, we've got experience of looking after clients that have come back from all over the world. So very happy to help in any way that we can. Okay, so enough about us. Let's talk about some basics of financial planning. So, all financial planners will carry out a version of these 6 steps to create a financial plan. You can attempt to do this yourself, but, no different to other professionals like a doctor or a lawyer, a good financial planner will have seen and heard a similar story to yours from numerous other clients and can give you the benefit of their collective experience. So start firstly with assessing your financial situation. And if you don't have one already, create a budget to plan your income and expenditure on a monthly basis when you return to South Africa. And from this, you can start to get some goals going depending on your age, your lifestyle, and how many dependents you have in your family. At the end of the webinar, I've got a free sample budget tool that we're going to be launching that you could use to get started. Now, next, you need to think about your attitude to risk. If I asked you to score what you're comfortable investing in, with 0 being money under the mattress at home, 10 is some obscure risky hedge fund or Bitcoin, with potentially high returns but also huge downside, what number would you give yourself? And with all these sort of factors combined, we can start to create a financial plan. And if this process seems difficult, scary, don't worry. We do this regularly with new clients, and I'd be happy to guide you through that process. One of the first key steps is to understand what you have, your assets. So that's what's on the left of the screen now. And then on the right, what you owe, which is what's called liabilities. Examples of assets are things like pensions, cash in your bank, property, etc. An example of liabilities might be things like credit card debt or overdrafts, loans or mortgages, and maybe an outstanding tax bill. So taking your liabilities from your assets to give you a figure is your net asset position. In theory, that's what you're worth on paper. And once you have that figure in mind, you need to start to budget for your move to sell. We'll wrap up today's webinar with a simple budget spreadsheet to help guide you along the way. So now that you have, or you know how much you are working with, your net assets, let's think about how much you want to bring back to South Africa. And perhaps maybe let me rephrase that. What should you bring back? So let's think about it another way. If we were looking back 20 years from now, how would you rate South Africa's success on a scale of 0 to 100? 100% is that South Africa resolves its issues with corruption, becomes an example of good governance, and potentially the next world superpower. Apologies for that. And 0 being that it ends up going the way of Zimbabwe, associated economic issues, flight of capital, maybe the kind of challenges that we've seen recently. So where would you place it in your gut feel if we were looking, back 20 years in the future to now? So there's no right or wrong answer to that question, but it helps a financial planner like me understand what your gut feel is and whether we need to be hedging your gut feel. So what is that number? You've probably got a figure in mind. And this maybe should guide your thinking when it comes to your investments, your property, your local savings, etc. And many of you may want to have 100% invested in South Africa. And if that matches your belief for the future, fantastic. That's great. But if not, then surely you should match your portfolio in a way that matches your personal belief about the future of the country. So that could be anywhere between 25% offshore, maybe half or 50% offshore, 75% or the majority offshore. But regardless what you do, it's your decision and must match what you believe you're comfortable to have invested in the country going forward for a long way into the future. It's your decision. Okay, diversification is a key investment strategy. One of the things that you may have heard is don't have all your eggs in one basket. In the event of a worst case scenario, you may need access to some form of a ring-fenced offshore investment. So many local options will involve investments coming out via South Africa. We call these in the industry asset swaps. They could be subject to exchange control limits. That's currently 1 million rand per individual without certification. And then the next 10 million rand you need to do with clearance from the Reserve Bank and SARS. And those annual limits are set by the Reserve Bank. They're not set by Parliament, so they can be subject to change fairly quickly. And what about currency? This is one of the age-old questions I'm often asked. What is the exchange rate going to be in the future? Unfortunately, we don't have a crystal ball, so all we can really do is look at the trends over time and see what inflation has done to the rand against sterling, as an example here. So, over the last 40 years, you can see that it's depreciated significantly from about 1 to 1 back in the 80s, and now we're sitting around about 20 rands to the pound. So the underlying trend, unfortunately, is only going in one direction. In the last 40 odd years, you'd effectively have lost purchasing power. It's depreciated by about 1,200%. In real terms, 1980, a million rand would have got you 540,000 pounds. And today, a million rand will get you about 50,000 pounds. So it's a significant difference over that time frame. So when it comes to making sure that you're set up and ready to return, a couple of the key points that I'm asked about. So, can I retain a UK bank account? Why would you want to? Well, because it makes it easy to maintain certain things in the UK. It's ideal to keep a foreign currency account if you can. And I'd always recommend, if you can, just put your direct debit for a UK phone number through it, so then you've got the ability to still get one-time PIN numbers for banking, etc. But it just allows you to keep that footprint going, and if you wanted to at some point in the future, maybe return, if the other way, if that was to happen. One of the things I'd highly recommend is to look at getting the latest generation of digital banking apps. I'm a massive fan of Revolut. All my clients I encourage to go and get it. And the reason being is that it allows you to spend in South Africa on a debit card or by tapping your phone, and there's no foreign transaction fees, and the spread rate, the rands to pound spread rate is really good with these kind of things. And also, you might have thought about if you want to plan out your UK or renting out your UK property and how you go about doing that. So let's move on to that then. That's one of the other big questions that I often get, did you acquire properties overseas when you were an expat? Do you plan to keep it and to rent it out? And are you aware of the implications and from a tax and a legal perspective of doing so? Since 2015, the UK capital gains tax is now applied for foreign landlords at rates of between 18 and 28%, combined with estate agents' fees. You could lose up to 30% of your investment if you needed to sell at some point in the future. You can also no longer claim the interest portion as a legitimate expense. So the tax bill of renting out property may be higher than you think. And if you need to remortgage the property, it's highly unlikely a UK high street bank will allow you to do so once you're back in South Africa, unless you can be left on a standard variable rate, an expensive interest rate due to the rise in the UK that could lead to a much higher monthly amount. So if you can secure your mortgage with a high street bank before you leave, we would highly recommend that. And if not, we can assist with remortgages for those of you who are now back in South Africa and worried about this issue through our UK mortgage team. Have to help you get to the bottom of that if it helps. One of the things that's great about investment property is that you can grow your wealth through leveraged property. You might have heard of a guy called Robert Kiyosaki and the sort of rich dad, poor dad approach to investment. So I'm a big fan of it. Being a landlord myself in the UK for 20 odd years, both residential and commercial. So if you're leaving the UK property behind, could you do it in a more tax efficient manner? There are options to own investment property through things like limited companies or even a pension fund. So why not attend one of our more detailed future seminars about how to be an expat landlord, or send me a message and I'll happily have a chat with you about this, if that's what you're thinking of doing. Okay, one of the areas I'm often asked about though is the dual tax agreement between South Africa and the UK. A dual tax agreement, or DTA, is put in place to ensure that you're taxed only once when you live in a country and have assets in another. There are a number of ways you can fall foul of the DTA by not correctly reporting your tax status to either SARS or HMRC. So one thing to be aware of, common reporting standards is a shared data arrangement where the UK and South Africa authorities will catch up with you if you're not paying the correct tax in the right jurisdiction. So don't risk not paying tax to one or other country and hope you won't be noticed. You could come unstuck and that could be a crime. But here's some good news. It's also one of the most tax efficient jurisdictions in the world for foreign pension income, but a little bit more about that later on. Okay. I personally don't like the term retirement planning. I think it's pretty outdated, and instead we'd rather talk about setting a date when you're working, not because you have to, because you want to. So how much time have you spent thinking about what financial freedom in South Africa would look like when you return? Would you be sailing, surfing, golfing, or traveling? And how do you ensure that you have sufficient rands income in place to do what you love so you can enjoy your retirement? So here's a question. If you were going on a 2 weeks holiday this year, how much time would you spend planning and making arrangements? Maybe a couple of days, maybe 3 in total, perhaps more. Well, your retirement is potentially a 30-year holiday that you need to plan for. So surely it's worth an hour or two of your time to make sure it's right. The longer you leave it, the harder it becomes to reach your retirement goal. If you start early, say in your 20s, the number of steps to your goal are much smaller and more manageable. And regardless whether you have set the time aside, the earlier you start, the better. The longer that you leave it though, unfortunately, before starting, the steeper the mountain becomes and bigger the steps are needed to get you to that goal. If you leave it too long, the mountain could almost impossible to climb, and your goal becomes almost unachievable. And there's a fantastic Indian proverb that the best time to start saving was 20 years ago. Next best time is today. So done correctly, a passive income option can be built up to provide a full-time salary that you move on to at an age when you want to retire. And this is a very important part of our role to select investments that protect and grow your pensions and other savings investment vehicles to provide this for this sort of 30-year plus job. So as part of the planning process, a good IFA will identify your attitude and capacity for risk. And this also takes into account your age profile and time frame that you have until you need the money for retirement. Nobody is the same. So look out for a bespoke solution that takes into account your age profile, your needs, risk profile, and long-term goals. You know, we aim to make sure that your money will outlive you rather than you will outlive your money. So my core area of specialism is helping returning South Africans to reconnect with their UK pensions so you can greatly improve your retirement in South Africa. It's likely you will have paid into a private pension fund at some point when you've worked abroad, particularly if you've been in the UK. And in March 2017, the UK government actually introduced a 25% exit tax if you want to take your private pension out of the United Kingdom. Previously, a lot of returning South Africans were moving their pensions to other more favourable tax jurisdictions to make sure they got a better performance and thus an income in retirement. Now, this move by the UK government is perceived as a way of them keeping investment in the UK whilst also trying to increase tax take from expats returning home. So this tax could easily go up or down in the future. So you need to ask yourself, a question: do you want your private pension to be at risk from changes in the law from the government of the day, or would you like to at least know what your options are that are available? Whilst thinking about that, the UK's pension system is also under significant strain because of its ageing population and low interest rates. And this has meant that a lot of vanilla pension funds have underperformed, and many schemes have significant deficits that have been magnified by the COVID-19 pandemic. By leaving your pension in the UK, it's at risk of being devalued by the UK government, taking more in tax, or the company in question could go insolvent, depending on the type that you have. A recent report from PwC identified that 5% of big companies in the UK are at risk of failure, exactly like British Home Stores, Monarch, Carillion, and a few other names in recent years. So, thousands of BHS workers lost out on pension benefits and have had their retirement ruined as a result. If this concerns you, don't worry. There are other better performing and sometimes safer options available to consider. If you do have a UK pension, it might be what is going to pay for that financial freedom or the 30+ year holiday that we call retirement earlier. So ask yourself some questions. Do you know who your pension is with? Do you know how much it's worth today? Do you know what it's actually invested in? How badly has the coronavirus pandemic impacted on it, and how is it performing against its peer group? And what will it potentially be worth in the future? If you've answered no to any of these questions or you're not sure, then feel free to contact us and we can use our free pension reconnection service. And our team will simply contact that pension provider on your behalf and get all of the information above, and depending on what you're looking for, come back to you with some options. So why is it so important to gather this information? Well, remember what I said about the tax break available under the dual tax agreement? Well, with the correct UK pension, you could receive your pension income in South Africa tax-free. And with the incorrect type, the UK government could tax up to 45% of your income at source when you retire before you're able to access it. If you want to remove your pension outside the UK, it could cost between 25 and 55% as an exit charge, which depends on the method that we described earlier. So with the correct type of pension, you could do this as a South African tax-free when you're over the age of 55, and thus giving you a large lump sum to consider other better performing and tax efficient solutions that are designed specifically with South African residents in mind. So why not find out for free, and we can let you know what your options are and take it from there. Question is though, what if you don't have a UK pension, but you're looking for something to protect your investments, for when you've returned to South Africa? So first of all, consider the reasons why you should. Do you want your investments in a currency other than Rand? Do you want the investments not affected by the likes of what we've seen in the last few weeks in South Africa? Do you want your investments not to be subject to an estate duty charge at some point in the future? And do you want investments with exposure with everything from gold, international property in one tax efficient solution? If you answered yes to any of these questions, then don't hesitate to reach out to us on that as well. Okay, last little bit from me is, I said, the long-awaited budgeting tool. So if you need a hand with budgeting, don't hesitate to drop me a line. And what we can do is just take you through how this works and send you over a free copy on an Excel spreadsheet. Really, we've worked on it with a number of clients and trying to get an average of what we think is right for a typical sort of family of 4 scenario going to Cape Town. Obviously, we appreciate that the costs, etc., may change depending on where in South Africa you relocate back to, but hopefully it will give you an idea of things that you need to be thinking about and the sort of costs that may need to be thought about depending on what kind of lifestyle you want to lead when you come back. Okay, so on to our Q&A session. If you haven't already done so, then please ask a question using the Q&A button at the bottom of the screen, and I'm going to do my best to answer them now for you. If you'd like to know more about anything that we've discussed today or have any further questions you wish to ask in more detail, then don't hesitate to connect with me through the various social media channels that you can see on screen now. Okay, so just give me a second while I just stop sharing the screen, and let's have a look at some of the questions that have come through. Okay, so I've got the first question here on WhatsApp from Steve. Thank you, Steve, for your question. The question is just in relation to the UK pension income. The 0% thing. How does that work? And a bit more clarity, I think, is what you're asking for there, Steve. So thank you very much. So a bit of background on that. So yeah, it's been around since 1962 as part of the Income Tax Act, and it's basically a provision where if you've accrued a pension through foreign employment outside of the Republic of South Africa and you come back, then what you're able to do is draw income from that solution at a 0% exempted tax rate in South Africa. The challenge with the pension side of things really comes down to that quite often people are being taxed incorrectly in the UK at source when they don't need to be. So making sure it's set up in the correct way is a really, really important thing to make sure that you've got right. Okay, hopefully that asked your question. On to the next one. It's just popped up from Gregory Simpson. So Gregory, thank you. If retirement is still in the future, perhaps within the next 5 years, is there any action you should be taking now in terms of a UK pension? Yeah, great question here. So look, the challenge with UK pensions is that the system has evolved over a number of years. And what's quite often in place now is a very homogenous, sort of a generic approach to pension investments. Okay, so the analogy I use is it's often like driving a car. You're in the same car as everybody else. You're doing 55 miles an hour in the middle lane of the motorway. It's a 4-door Ford Mondeo. So cost effective, cheap, but potentially not very good for where you want to get to in the longer term. What you could potentially do is look at something that's a little bit more tailored to what you want. You might want to, for example, go and invest in the latest tech stocks. You might want to have exposure with everything from Square to CoinShares to Apple and Facebook, depending on your risk profile. And quite often what you'll find with the more generic UK pensions is you're in the same car as everybody else doing the exact same speed. So, all that we would advise is have a look at what you've got. Let's see how fast it's going. And if all the other cars are going at 70 miles an hour and yours is only going at 55, then maybe there's something we might need to look to do to ensure that you have as much money available to you when you retire in South Africa. So yeah, highly recommend having a look at it before the date rather than afterwards. Okay, On to our next one, and thank you for this. If we wanted to start off an offshore investment, is there generally a minimum amount that needs to be initially invested? Great question. Look, the short answer is no, but there are some of these solutions where the more that goes in, the cheaper it gets. So it's what we call a quantum point, So for example, I mentioned about if you haven't already got pension arrangements in place, maybe you're already back in South Africa, you've got all of this money tied up or in I don't know, property in South Africa, and maybe what's happened in the last few weeks has made you think, actually, maybe I need to get a bit of that outside of the country and away from everything that's happening. Maybe we could look to do some form of a structure outside of the country if that's what's right for you. As far as a minimum investment, that might be a more of a bespoke solution, and those kind of solutions might need a minimum amount to get into them, north of say £50,000. But if you wanted something that's just to give you a bit of exposure offshore, but not through the normal solutions, again, entirely possible. There's a number of locally sourced investment platforms that we could utilize that have a lower threshold. So long story short, there's pretty much something for everyone, depending on how far that you want to go with it. So hopefully that answers your question. Okay, another question here from Sue. Thank you, Sue. If you rent out property in the UK and live in South Africa, do you pay tax on your rental income in the UK or South Africa? Great question. Okay, so I've skipped over it a little bit, so just a little bit more on, and you might want to go and have a watch of the webinars that we've done specifically on the tax points. I work with a number of tax consultants that specialize in looking after clients in exactly these kind of situations, myself included as an example. And actually, one of the things that you've got to think about, firstly, is your physical presence. Okay, and that's the main sort of headline thing. Once you've been in South Africa for about 6 months, then there's probably an argument that you should be paying tax to SARS rather than to another authority around the world. Okay, so if you're then doing that, then really it should be going on your SARS return. Okay, but then there is an argument to be saying that if you are thinking about going back or have other ties to the UK and what's called a residency tie, then maybe you should still be doing a return to HMRC as well. So in that regard, I'd always recommend that you have a discussion with somebody like Janine Gelbroth. I can send over her details. She's one of my favored expat cross-border taxation specialists, and she can then tell you, with your circumstances of how long you've been back, what you should be doing, and where you should be claiming back expenses and where you should be paying your tax to. So hopefully, Sue, that answers your question. All right, moving on. I've got a question here on WhatsApp from Dave. Thank you, Dave. It was great to meet you the other day. Yes, this is the long-awaited budget family tool. So I'm going to just share it on screen now, just to show people how it works. And like I say, if you want a copy of this, just feel free to drop me an email, and my team will send one over to you. So I've worked on this with a number of clients in different areas around Cape Town to begin with, and just sort of try to take a bit of an average of most of the things that people should be thinking about when they come back to South Africa. And what we've done is that we've highlighted the cells in yellow, so you can update your budget to what you think you're going to be spending in those various different areas. We're not all the same, but at least has a list of all the things that maybe you should be thinking about. So we've got everything from mortgage bonds all the way through to other sort of house expenses, utilities, looking after the pets, if you've got kids, sending them to school and the school fees and all that sort of stuff. And the other thing you've got is the ability up here to then choose the exchange rate depending on where it is at that point. So currently we're sitting about 20 odd rands to the pound. What if it's only shot up to 25 rands to the pound, where you can see how much of a difference it all makes and why the currency bit is so important. If it was to strengthen down to 18, again, it also has a significant impact. So I say completely free, Dave. We can email that over to you, and we will do after our chat the other day. You can have a good look through it and see if there's anything in there that maybe starts you thinking about what you should be doing. So hopefully that helps. Okay, well, we're going to look to wrap up shortly. So if anybody's got any other questions, please don't hesitate to put them on now. I'm just going to send a message on the chat, okay, again with all of our social media handles, so feel free to connect on there. But thank you everyone for attending. I hope it's been worthwhile. We will be communicating when we're planning to do our next webinar in the series. As you've seen probably from the YouTube channel, we do a number of different things, everything from how to manage property, overseas structures and investments, what to think about from an estate duty perspective if you keep your property back in the UK, how pivotally important it is that you have a will. That's one thing I always recommend to clients. If you do nothing, make sure you've got a will in each of the jurisdictions where you own cash or a property or something like that. I've dealt with some horror stories, sadly, over the years where, a client, very well-meaning, has only got a South African will or only got a UK will, and the courts have taken years to settle down and work all of that, that situation out. So, try not to fall foul of that. Okay, one last question that's popped in here. Let me just answer that quickly. Okay, thank you, Steve. Yeah, that's great. Yeah, thank you very much. So just a kind word there. Yeah, look, at the end of the day, why do we do this? We're here to help. Okay, look, we're not going to be able to help absolutely everyone. We understand that. Some people might have arrangements already in place. People often choose to do it themselves as well. Totally understand that. It's kind of like making the decision on whether you're going to drive yourself or use an Uber. Sometimes it makes sense to use an Uber rather than to drive yourself around all the time. But we're here to support in any way, shape or form that we can, that will make a difference to your financial planning journey and your return to South Africa. So I'll just pop up the contact detail screen again, just as the last bit before we wrap up. So yeah, feel free to connect with me on Twitter, LinkedIn or Facebook. And if you've got any specific questions that I haven't covered today, have a look at the other webinars that we've done, or send me an email and we can ping you a copy of that budget tool if that's what's interesting you. So if there's no further questions, ladies and gentlemen, we'll wrap it up there. Thank you very much for taking time out of your busy schedules today. I hope it's been worthwhile, and I look forward to speaking to you again in due course.